What is money? Most of us think of it as cash in our wallet or numbers in a bank account, but economists define money by what it does. Money does three main things. It tells us how much things cost, lets us save, and it's what we trade with. If something can do all three, then it works as money. Most people think when you deposit your money in a bank, the bank saves it in a big vault or account. Then, when someone else needs a loan, the bank takes your money and lends it to them. That seems logical, but it's not how modern banking works. In reality, let's say you go to a bank and ask for a $20,000 loan to buy a car. You might imagine the bank looks around and finds someone else's deposit to give to you, but that's not true. The money didn't exist until you asked for it. The bank simply types $20,000 into your account on a computer. It's not transferring money from anyone else, it's essentially creating brand new money just for your loan. This process is called bank credit creation, and it's how most money in the economy is created today. Now, you take your $20,000 and pay the car dealership. Now their bank, let's say Wells Fargo, has that money, not your original bank. Now your bank owes $20,000 to Wells Fargo. So how do banks settle this difference between each other? They use something called reserves. Reserves are like a special digital currency that banks use to pay one another. Every bank has an account at a Federal Reserve, which is the central bank of the US. Think of it like the bank for banks. So now your bank sends $20,000 worth of reserves to Wells Fargo, and now the transaction is complete. Banks don't always have enough reserves to make these payments, so they borrow reserves from other banks. The interest rate they pay for this is called the federal funds rate. This rate is controlled by the Federal Reserve, and it's a key tool for managing the economy. If prices are rising too fast because of inflation, the Fed raises the rate, which makes loans more expensive and slows down spending. On the other hand, if the economy is weak and people aren't spending, the Fed lowers the rate, which makes loans cheaper and encourages people and businesses to borrow and spend more. So in simple terms, when you get a loan, the bank essentially creates new money, and then when you spend it, it moves into another bank, and banks use reserves to pay each other back. Banks aren't the only ones creating money. Governments do it too. When the government spends more than it collects in taxes, that's called the budget deficit. To cover the gap, the government issues bonds, IOUs that say we'll pay you back later. Investors buy these bonds, and the government uses the money to fund things like highways, defense, and Social Security. Those bonds are just another form of money. They're assets for people who buy them and liabilities for the government. A question that has recently been brought up is, could the Federal Reserve itself be replaced by AI? Well, today economists meet every few weeks to decide how to adjust interest rates based on the limited data they have. But AI could analyze real-time information across the entire economy, predict inflation more accurately, and respond faster. So the next time you buy something, remember, money isn't just paper or pixels, it's a system built on loans, government policy, and trust. Thank you for watching, and see you in the next video.